Good evening, everyone, and welcome to this new webinar. We started 6 weeks ago. So that is Portfolio Management During Crisis number 6. I hope you enjoyed it and you're going to enjoy this one. It's going to be a long one, so let's try to be effective. So very quickly, as there are many new people that are joining today, a quick presentation of me, and you're lucky you get a picture on top of it, which is even better. So I started trading in 2000 in Paris for a small asset manager when where the assets under management were roughly around 50 million euros. I started with the French market, then I did the whole European market, then I trade the US as well, mainly stocks. And then in 2004, I came to London and I worked for a hedge fund. I worked from 2004 to 2008, both first on the long only product, then on the long short. And during that time, the asset under management on the western part went from 150 million to 600 million. And the overall company, which was still considered as being a small shop, was managing across assets roughly 3 billion. Then in 2009, I joined a prop trading shop here in London, which is Infinity Capital Market, which is the UK subsidiary of First New York in the US, and where I've been trading from 2009 to 2018, an absolute return mandate with no asset regions constraint. So literally, I could be trading whatever I wanted, whenever I wanted. And I stopped trading the way I was trading at the end of 2017, start of 2018, because I was tired. I had enough of doing the same thing with the same mandate. And for those of you who I met before, I worked for another educator from 2014 to 2017. And in 2018, because some people still wanted to be mentored by me, they came to me. And we started my own mentoring program, and I've done as well my own video series that I started in October 2019. So this is my background. If you have questions, if you want to know more, you can ask me later. So today, what are we going to be covering? As you remember, last week we looked at the breakouts from the tech names like Netflix, Amazon, mainly based on option expiry. The option expiry that is happening every third Friday of any month. We look at the really bad retail sales numbers. We look at the banking sector across the world, the start of the earnings season, and as always, we look at the oil market WTI. So today, there's going to be, as always, a start with the price action. We're going to be looking at macro, when we will be doing the flash PMIs. We're going to be doing, again, the oil market, because as I've been saying for quite a long time, if you don't understand what's happening in the oil market, it's going to be hard for you to be trading this market. So important to understand what is ongoing. Then we will try to see how to generate IDs. And I come across 2 IDs, both on the FX market and based on the earnings season. For the banking sector, Europe, US, and watching the Italians BTPs, for those of you who were not with us last week, the BTPs are the Italian 10 years. So today there was a deal that could have happened in Europe. As always, there is no deal, meaning that we could see some spread widening tomorrow and some pressure coming again on Italian BTPs. We won't be covering it today, but if you want to have a bit of understanding of what's happening, you can have a look of what we've done last week. So we discussed as well implied volatility and realized volatility. I think it was 2 or 3 sessions ago. So looking at now, we're going to jump into the price action and see how the assets have been doing. And as always, I like to start with the S&P. So the S&P has been trading sideways between this 2740 and this 2860. So what you see is the implied volatility is still pretty high. The implied volatility with the VIX is at 40%, but the realized volatility came massively. So a session like yesterday was very boring. Maybe the last 10 minutes with the kind of sell-off. Today there was a bit more volatility, let's say 40 points on the S&P, but I mean, really the swings, the intraday swings have been coming down massively. And we will see later what are the reasons for this. So if we look at the S&P, this is the picture. If you look at the NASDAQ, the picture is roughly the same. Again, this is for the main index. We discussed the banks, so we're not going to be looking at the banks. I think there was some questions already about, where to look for the credit market and the high yield market. You could be looking at the high yield ETF, which is this one. We know that, again, the Fed came and jumped into the market on the 23rd of March with Infinity QE. So you have the rally. And since then, actually, for the last 5 sessions, the credit has been struggling. And it feels like there are 2 components. Obviously, there is a kind of reversion to the mean, and the Fed as well has been slowing the pace of their buying program. So instead of doing something like 30 billion every day, they are only doing 15 billion. But if you look across the credit, the bond has been coming a bit. If we look at the US 10 years, which is now at 60 bips, so we are at low level. So that's for the credit market. There is some tension again on the credit market. If there is more stress in the credit and the economy, there's going to be more stress in the credit. So let's look now at the currencies, because that's the other asset classes. So if we look at the currencies, like let's look at the DXY, which is in the reality 60% like the euro. The dollar has been strengthening a bit, not that much, but a bit. So on the week, it's almost flat. I think there's a bit of wait and see everywhere. So if we're talking about portfolio management trading, we should adapt our style from a month ago or 2 weeks ago when the volatility was pretty high. Now the volatility is coming down, so you should be careful on your time frame. You should be adapting your style. And talking with many experienced traders who have been making decent money so far. Now it's more a question of not putting too much exposure, because it could go one way or another. And here, because of the earnings season, we need to be careful. Another one that I know that you like is the gold. So the gold that we looked at last week, I think the big level again is this 1800. We are close to this level. If we go above, then it's flying. At the moment, it's not. And you have the other commodities, but we're going to be covering the WTI. So, and we're going to spend some time on it. So let's go back now to this. So first thing that we're going to be looking at macro is obviously the flash PMIs. Why? Because we're going to have 5 or 6 slides of things that are literally plummeting. So here in this one, we have the US flash PMIs that came today, where we get the US services, which is in blue, where the business activity is now standing at 27%, where it was at 40% a month ago. So it is plummeting. Again, there is this 50 line. If we look at the US manufacturing, it is at 37%. And that tells you about how much it can go. I don't know. Question will be, how low can it go? Maybe this is the bottom in the PMI. Maybe. The reality is that tells you that the economies are really suffering big time. I mean, we all know that. If we do the same for those European PMI that came out, so here this is for Europe. As you can see, the picture is the same. We are going into the 30, 35. What is more interesting is trying to look at the correlation between the PMI and what kind of euro area quarter-on-quarter annualized you'll have. So looking at this chart, you're going to end up with between -6 to -8%. And actually, if you look at the model from market, they are telling us that they are expecting a 7.5% GDP collapse. So that is just huge. Another chart, again, this is going to be the same, which is the Eurozone manufacturing PMI versus the Eurozone service PMI, where the manufacturing is at 33.6, again 7.5% probably contraction in Europe. Just not only because I'm French, but because this chart is just amazing. The French service PMI, which went to 10.4. And really the question now is, you do have like two questions, is when will the economies and the societies reopen again? So if we look at Europe, we do have like many countries that have decided to start to reopen the economies from the 10th, 15th of May. And the second question is, what will be the path of this? How quick that will be? And more importantly, if we see some cluster of coronavirus again, how the market and how the economy, more importantly first, is going to react. So those are the questions. It's not even binary because we know that we're not going to reopen suddenly. But those 5 charts tell you about, how deep the recession is going to be. And that means if you go solo, you're not going to recover quickly. So against all of those economic data, as I did last week, a couple of weeks ago, we are having at the same time with those fundamentals, the central banks that are moving big time into the market. So on the left-hand side, you get the Fed balance sheet, which is now above $6 trillion US dollar. For Europe, we get 5 billion and above. And today, I don't know, for some of you who have been trading, there was some rumors, guess when, right when the US market opened, that the Bank of Japan could do unlimited QE, or at least be doubling the size of its balance sheet. Again, the timing is always the same when the US market is opening. And to put everything into perspective, so I've done a Facebook video on this, a YouTube video, sorry, where I explained the size of the balance sheet of those 3 different players. In Japan, the Bank of Japan balance sheet is already 100% of the GDP. So if you think that they're going to double and do even more, that tells you that they are going all in. This is pure kamikaze. And that means on one hand, we get the fundamentals that are really, really bad. And on the other hand, the central banks that are putting a lot of money. So for us as people who want to put money at work, and either on the short term, on the long term, mid-term, we need to take into account that there is a lot of liquidity coming into the system. So let's start with all the headlines. So this is the oil market. I'm not making the headlines for those of you who have been following me. You know that we have been covering since the beginning the oil market. So here, this is the contract that matured on Tuesday, which is a bit misleading because the volume was very small. But literally, what we had is the contract went negative, and it went negative mostly because of the contango. So we talked about the contango many times. So on the left-hand side of this slide, we get the price of the future contracts today. Okay, so that's today. And here, this is 1 week ago. As you can see, on the prices, so that tells you the oil structure over the last week. So here we get the June, the July, August, September. But we have a flattening of the curve from 1 week to another. And we are now have expectations of a lower recovery. So if we take, for example, the November contract a week ago. It was expected to be at 34, whereas now it's expected to be at 29. So that tells you that the whole sector is going to suffer, but more importantly, because, so what is the contango, please, in simple words? So I'm going to explain the contango when we're going to be talking about the USO, but the contango means that if you take the July contract, the July contract is below the price of the August contract. So that is when the price of the longer contracts are higher than the ones that are closer. And you are saying that you can be long those contracts if you can storage this oil somewhere. The downside is, and this is why this is the biggest reason why we had all of this, is because there was no more storage. So, and that leads into, as I said, for me, a clear sign that the economies are not expected to recover in the next 2 to 3 months. If we look here at the price structure, literally we get now $30 roughly, but you can see how it is now flattening. So that is not a good sign for the economies, and that is not a good sign for the sector. So that I think what is important for retail traders, so as I warned you 3 weeks ago, we always need to think about what's the best vehicle to be buying or selling something. The downside is when you look at this sector, many people went for the USO. So the USO is the ETF which holds near month NYMEX. So that will be, you'll be holding these 1522 contracts. And when you have to do the roll, because when it is expiring, if you don't hold the position, that means you need to take physical delivery of the oil. So you're selling the contract at, let's say, 15, and you're buying the one at 22. So you are systematically losing money. By buying by rolling this position, the USO has been always underperforming the WTI. So what they have been coming with is a new, let's say, a new mandate. So instead of holding 80% in the front months and 20% in the second months, they are now saying that they might, discretionary style, be buying August, September, October, depending on the contango. So the contango has been killing the USO. If we look back at the chart of Monday sell-off, that is not because of the USO. Why? Because the USO had already rolled the position. So what you had is some investors, some traders came on Monday, long the contract, and they realized that actually there was no place to store this oil. So what you do when you're supposed to be receiving, like, barrels and you have no storage, you are just selling at no matter what is the price. So that is what has been happening. And if we come back into the USO, now they have to change the mandate. I think pretty soon they're going to be doing a reverse split. Reverse split meaning that you're going to have one new shares if you had 8 old shares, and I think it is on the 28th. And that happens very quickly when the price of your asset is going like this. So as you can see, the problem with the USO is the price went massively down, and in the meantime, 4 to 5 billion of new assets came into that product. Why? Because retail traders thought, okay, I want to have exposure to oil, or what I'm going to do, I'm going to be Googling up USO ETF oil, I'm going to be buying, and then they realize that actually they don't have, or they don't realize first, but when it's coming down, then they will realize that the ETF is, this USO is a very bad proxy for the oil. And that tells you here, if I want to be boring, that tells you something that is extremely important. If you buy an ETF, you should be checking two things or three things. You should be checking first, what is the counterparty? So who is making the ETF? The second thing that you should be checking, what is the mandate? So what can I be long and short? How they structure the ETF? And finally, what is their weighting? That's something that you should always be doing, and don't think that ETFs are always nicely built. Yes, I'm with you. I agree with you. Many retail traders get absolutely murdered on that, just because they didn't understand what was ongoing. So hopefully you missed this trade that was a killer. Again, if you look at on YouTube, I think it was on the series number 3 where I explained better the USO in more details and how it is really a killer, and the Contango, why the Contango really works if you do have like some storage, but these days you don't have any storage. And that was the struggle for everyone. If you want to be putting some oil somewhere, the tankers were already full 3 months ago. So if you look at the tankers, we look at the charts 3 weeks ago, they were doing very well. So that's the price action here of Frontline, which is a Norwegian tanker. We discussed that during previous sessions. You get the same here with the HT holdings, which are trading very nicely. If you want to have some exposure in Europe, there is this Dutch name, which is Vopak, which is the world leader in storage. They came with the numbers this week. And that tells you that, again, this is an industry in the sector that has been doing very, very well, which is storage. And probably it's going to do well for the next 2 to 3 months. If we come back into the drivers of the WTI oil market, again, this is supply and demand. As the prices have been absolutely murdered, there's going to be a lot of natural cut in terms of production. So supply will come massively down. Plus, there have been decision about forced cut from OPEC and non-OPEC. So that's going to help. That's going to help or give some relief on WTI, but still, we need to swallow those couple of months or 3 months of oversupply into the market. So now I would like to look at the currencies and how this WTI move has been impacted and could be impacted even more, some of the currencies. So the currencies that are the most affected by WTI, and you all know that, or maybe you don't, but that's the Canadian dollar. So you could be looking at the USD versus the Canadian dollar, or the CAD USD, the Russian ruble, the Norwegian krone, and you could be looking at the EMEA commodity peg currencies. So here I'm going to come with one idea. You'll see, I mean, I think it's an interesting one. It's not an easy one to do, but I think there is a trade here. So let's look at the picture of what has been happening. So this is the USD NOK, the Norwegian krone. And as you can see, since WTI has been under pressure, the krone has been weakening big time. So now we came back a bit, but that tells you about the volatility where we went from 950 to 12. So that's a 20 to 25% to 20 to 25%. So huge move. So if we come back into this slide here, I'm interested in those one, the commodity peg. Why the commodity peg? Because those GCC countries, which are the Gulf Cooperation Councils, are made of 6 countries. So we got Bahrain, we got Kuwait, we got Qatar, we got Oman, we got Saudi Arabia, and the United Arab Emirates. So if we think about the USD SAR, which is as a peg of 375 since June 1986. Okay, so I was making the research. I was making some yesterday, and I came across this good paper. So you should have a look at this one. This is an interesting one. What we have and we know from these regions is they have been pegging their currencies since the 80s. Okay, and those dollar pegs have been helping the whole region very, very well in terms of stability and in terms of cooperation between those 6 countries. Okay, but if you have WTI at this level, if you get oil at this level, then there might be an issue. So if we take the example of Saudi Arabia, 63% of the revenues is coming from oil, and Oman is something like 76%. So for those of you who have been in the region or know a bit of the region, there have been some noise for quite a long time about Oman and probably being the weakest link in the region. And if we look back in 2016, there was some rumors as well of a potential devaluation of the real. My view is, as oil is really low, it's plunging now. If there is a time for those peg to be under massive pressure, this is now. So why I'm saying that is, when I talk to some of my mentees that are in these regions and that have been raised in this region, they're going to tell me, look, I've always looked at the peg, and for me, this is a done deal. But the concept of a peg is a peg could go away. And here, I want you to be extremely careful. Okay, so this is a trade where the chances of it happening is probably less than 1%. Because there's not going to be a devaluation overnight, but there is a clear risk. So I think if you are local and you get exposure to those peg currencies, for me, the best trade to do is putting this money in US dollar, because having the risk of carrying the risk of having those currencies, where actually you can have the US dollar, okay? But then the second move will be, what happens if the peg goes away? Okay, so here I want to look into the next few slides and understanding how it works. So here, that is from the IMF, which gives you the fiscal break-even of oil price by country for those 6 players. So as you can see, all of them except Qatar, which is a lot into gas, all of them are at 40 or above. Okay, 40 and below, above, and probably 60 and above. So when you have oil, that actually oil is these days here, between here and there, okay? And the budget is $20 to $40 above. So what does that mean? That means that this year, you're gonna be bleeding money. So yes, you can argue that the whole world is gonna be bleeding money, but when Saudi Arabia in 2020 has a budget at $76, when Oman, which is already under pressure, has a budget at $87, for example, that tells you about the picture of the stress that we could have. So next slide, which is from this ING paper, which I really, really like, which is the percentage of GDP of their fiscal balance and their current account balance. So as you can see, for Oman, we are talking 30%. So if 1 year you have a deficit of 30%, and you know that the expectations for 2021 for oil are still pretty low, or at least if we go back 2021 for Oman, which is in yellow, where the budget in 2021 is at 80, that means you are going to be running another deficit. So let's look at what you have here in terms of, so that's the charts from Trading Economics here, where I use the foreign exchange reserves. So the top one is from the Saudi Arabia. As you can see, it is massively coming down from the top of oil in 2015. It is coming. Oman is still doing fine, but we need to take into account that this year they're going to be running a deficit between 15 and 30%. So versus all of this, and there is no, and let's put it that way, this is why we got these headlines yesterday. So yesterday, the Saudi finance minister came on the line and said, on the tape, saying, we are fine, we're gonna have access to the market to the size of, 110, 120 billion real. My conviction is there is still a possibility that the peg goes away. Okay, this is a small one, and I understand that people that have been living in the region think that this is not possible. And again, this is the worst case scenario, and the whole region is doing fine because of the stability. But what we have is the worst case scenario of oil since 1980s. So the prices are back to 20, 30 years ago. But in the meantime, those countries have been running budget that are 60, 80s. So my trade would be the following. If you're local, you just put your money into US dollar. And if you're not a local and if you want to do a trade, there are two trades. The first trade is you try to do FX and obviously going short those currencies because your downside is very small with the peg. So if you think about the same kind of trades, that will be the Euro Swiss in January 2015. If you look at the chart, that's the same story. And the second trade, which is a hard one, and then, you know, either you need a lot of money and you need good connection with a prop desk at Goldman Sachs or Morgan Stanley, that will be to do an option. An option on the idea that the peg will go away. The timing, I don't have the timing. Again, this is not going to happening overnight. So we're probably talking 6-18 months options. But literally, and the odds are, again, very, very small. So this is literally the trades where, if you think about it, this is the black swan where you get less than 1%, but if it works, the payout is just going to be huge because no one is expecting it, and it's not been happening for the last 30 years. There is a lot of players again that, but looking at the fundamentals, there is huge pressure on the fundamentals for those countries. So that is the chart of the USD ZAR since 2005, but actually if you go back to 1986, this is exactly the same. So for the Omani Real, it's pegged to the USD, same. So it has not been moving since 1986. Again, the trade is either you change your money if you're local into US dollar, otherwise trying to find a way to do options or to do the FX. This is a tough one. Again, this is for, I'm not saying that you should be doing it. This is one idea. All the ideas that I'm putting it is just ideas. There are some that are putting as trades, but by no means this is for you to jump. This is just for me to explain to you how, when you're working for a hedge fund or when you're working for a prop trading, how you will create ideas and trades. So let's look now at the second idea generation. So it's earnings season. Again, it started 10 days ago with JP Morgan. And again, for those of you who have been joining, I like to be using either Benzinga, the first website, or Earnings Whisper to know when are the companies coming with their numbers. Just to check very quickly, I know that Intel was coming with their numbers after close. I'm not sure that they already come with the numbers, but why you want to be looking at the earnings calendar? Because you want to be identifying what the markets, the sector, the industry leaders are saying, because that's going to tell you a lot about what is happening in their industry or sectors. So for instance, tomorrow we get Verizon. Tuesday is a really, really big day. So if you want to take a day off from work and be trading the market, that could be a good day. We get 3PM, we get Pepsi, we get Pfizer, we get UPS, we get Caterpillar, we get DHI. Then on Wednesday, another big day, we get Boeing, we get GE, we get MasterCard, we get Spotify. On Thursday is a big one as well, with Amazon after the close, McDonald's, where I have a position, so this is why I put it here. But literally, you need to be looking at those earnings. So why I want to be looking at earnings is how to generate ideas. So what I know from my mentees and people that are contacting me is they have been struggling to be generating ideas because they tell me, look, the macro is all over the place. I don't know what to do. The macro is telling me that, you know, everything should go down the toilet, and because of bank intervention, we had a massive rally, and I don't know what to do. So if you are struggling with the macro, you need to find other ways. So this is what I'm trying to do and push you to do through the mentoring and the 4x4 video series. If you're stuck and only be doing the PMI kind of ID generation, you have absolutely no chance in this market because it's way too binary. So what you need to be doing is an active trading, bottom-up special situation. So here, I look at the ID generation and I listen to the IBM earnings call. So IBM, we all know this is a dog. This is a bad company. That's been a bad company for years. They have been making bad acquisitions. They have been very late in the cloud business. But still, you know, you can and you should be listening to those big companies because they are going to tell you something. So in the conference call, they said, and this is here, in March, our software transactions stalled nearly overnight as our clients shifted their focus to resiliency efforts. So when I saw that, I was like, okay, so that tells me overnight the business stopped on that part of the business. In the meantime, I had a mentoring program, and my mentee, who is in Europe, is working for a big software company. So part of the software company is you get a resilient business, which is 60% of the business, and you have a non-resilient business, which is making roughly 40%. And he told me overnight this 40% went down. And since then, it has not been recovering. So that was the second warning. Then at the start of this week, I had SAP coming with the numbers and telling us, you know, the market is really, really tough. And I know, as you know, I was trading in 2008, 2009, that those software companies are still extremely discretionary. So when you are running a company and you are suffering, the first thing that you're doing is first you are all the people that you are using for the outsourcing, you just fire them. Okay, so people on contracts, they go away. Then the second thing that you'll be doing, you'll be cutting all, or in the meantime, you'll be cutting all your software. So I try to look at the software business. We know that software, the software sector has been doing very well since 2016. Okay, if you look at the names, they have been outperforming very well. What we need to be careful is to make the distinction between software and cloud business. The cloud these days is probably doing very, very well. Why? Because everyone is sitting at home. All the companies are putting everything on the cloud. So cloud business is going to do fine. So I looked and I tried to look at, when I look at this news, I didn't want to have exposure to a company. I wanted to have exposure first to see what are the sectors. So again, I look at the ETF. And when I look at the ETF, as I told you, first, I want to be looking at the counterparty. Then I want to be looking at what is in this ETF. So I came out with two names with XSW and IGV. So let's look at the components and what do they have. So on the left is IGV, as you can see, Microsoft, Salesforce, Adobe, Oracle, big names. And on the right-hand side, you only get you get more names, and actually the weighting, instead of being 8% max, is going to be 2%. So that's really, really different. So that tells you one thing. Here you are buying a big cap, and here you are buying everything and small to mid cap. So what is the price action telling you? So the price action telling me, in the blue here, I got my IGV. In red, I got XSW. So my view here, and I think there has been a downgrade today from JP Morgan on the sector. Why? Because the sector has been doing very well. And as they said, and as I told you, is I think the sector will be suffering, and investors don't realize that there's going to be massive cut in CapEx and massive cut from companies. So the first, here you do have like 2 to 3 trades that are possible. And again, I'm not saying that you should be putting the trade, you do whatever you want. I'm not here to tell you what to do. Okay, I'm just trying to explain to you what is my process. So my process was to find an ID generation from the earnings season. So at any earnings season, when you are a trader or portfolio manager, you'll be looking at the tape, and there'll be companies that will be telling you some stuff. Sometimes you'll be picking something and you'll be jumping onto the conference call or be reading the transcript. So when I look at IBM and I saw on Reuters this news about, the cut, I was like, okay, I need to read a part of the transcript. So here, what is the trade? We know that big caps have been outperforming small caps massively since the start of 2020. So as you can see from here, you get outperformance of the blue versus the red, the blue being IGV, the red being XSW, and it's even more true since we had the sell-off. So you have different trades depending on your risk appetite and depending on your timing and how you can put the trade on. So if you can do a pair trade saying, I want to be long XXW versus IGV because I think there's going to be a reversion to the mean. You can be doing IGV short only, or you can be doing IGV through put trade or put. I'm not going to tell you what I did, but I think those trades where you have the possibilities to have different way of structuring the trade based on fundamental and price action are the best trades, okay? Again, those are trades, if you look at the volatility that we had recently and we still have, are pretty risky. So that means the risk management is extremely important. So what I wanted to do today is trying to help you to generate ideas on a different views that probably most of you are doing. If you look at the first part, which is WTI, we were already generating ideas with the tankers looking at single names. Today, I wanted to be looking at FX. So if we look at FX, we know that the Norwegian krona, the Canadian dollar are the currencies that will be affected. If you think about what could be the best risk return of all time, that will be the unpegged of those currencies. Again, the chances are extremely low, but the payout is extremely high. And the second part, if I look at ID generation based on earnings season, those are from what the companies are telling me. And then I look at the way to structure the trade, because I don't want to be, from the minute someone is telling me something and I'm reading something, to go immediately into putting the position. So I need to first think about how to structure the trade. So very quickly, for those who joined, and sorry for the other ones, so this is something that I've been trying to help people to be doing in the 4x4 video series. Why? Because I think retail traders, and when I started, that was the same, is when you think you get an idea, you think you get a trade, and in reality, it doesn't work like this. So to be successful in portfolio management, you need to understand first, what is the GDP, how are the economies working, the components, the drivers, the asset allocation versus the economic cycle, how it is behaving over time, expected returns versus realized return. Again, here, this is the concept of portfolio management and trading. Those are very important concepts. On the macro analysis, I give you 50 spreadsheets and more, helping you building your infrastructure. I give you access to the website. I give you access to the links. Literally, is helping you building your infrastructure. Then the ID generation. I want you to be making money, or at least first to be generating IDs in any market conditions. Okay, I don't want you to be stuck for 3 months because you look at the ISM and you don't know what to do. So these days, and as you can see today, I generate IDs that are not based on the ISM. I look at the ISM. I spent 10 minutes today looking at all those charts. We all know those charts. But I generated 2 IDs, one FX, so one macro, plus stocked with tankers that I've been doing for the last month or so. I know as well that I look at the risk management, so I'm not going to be trading USO because this is a bad asset. And in FX, I try to put a position, and then I know that it's going to be hard because this is a regulated market. There is not much access with brokers. but that gives you the idea of how to make 100 or 1,000 times what you've been putting on the table. Then on the second part, this is more bottom-up and active trading. And here, still what I'm going to be doing, I'm going to be looking at the quantitative fundamental analysis, because I'm going to be trying to understand what's inside those names. So if I go short IGV, I know that I'm going to be short Microsoft, and I know that Microsoft has been very hot. I know that their cloud business is really strong. So I need to decide, do I really want to have 40% exposure short the cloud, which I don't think is a good timing. And then I want you, through the 4x4 video series, to be building a strong watch list, weeks after weeks. I know it's hard, I know it's demanding, but once you try to understand that there are different ways of doing, then it becomes extremely helpful. On the technical analysis and price action, we started with that, with the price action. Why? Because the market has been extremely volatile. And in the meantime, you don't want to be putting a position if it goes against technical analysis and price action. So if we look at the S&P, we know, again, that the S&P is trading sideways. Let's say big range will be 2630, 2850. And in between, you do have like some support at 2730. As long as you are into those range, you know, there's going to be a lot of noise. But what is more interesting is, despite the market being flattish from one week to another, actually inside the S&P and inside the sectors in the industry, there are big movers. And I think now there is some catch up in the fundamentals because the earnings season is coming, and people start to think. So it's not like, you know, I buy, I sell. There is divergence between plays. Risk management, again, risk management, I'm really strong on risk management. I started with an internship in risk management. If, for those of you who want to be working in prop trading, and I know there are, or in asset management, this is extremely important. And then P&L optimization, it's about understanding where and how to be making money. And again, there are tools to do it. What I try to offer through sessions like this, through the 4x4 video series, through the mentoring program, is giving you tools to do it. Then, again, as I always said, the learning curve is just endless. So what about we jump into the Q&A session? If you want to watch the other videos, and you should probably, or if you want to, subscribe to the YouTube video, the YouTube channel, which is here. So let's start to look at the different questions. There are so many today. What will be a good security to track WTI then? As I said last week, and the problem with WTI is if you trade with the future, that means, which is a multiplier. If you look at the contract, let's not look at the June contract, but July, let's say you get a 20, that means it's a $20,000 size. So unless you get $100,000 portfolio, it's going to be hard, because that means your concentration is not going to be good enough. To be honest, I've been struggling to find any good ETF that are a good reflection of oil. If you take USO, you know, and that was before, that was only for a very short-term trade because of the contango. But here, because of the contango, that you know that the underlying are completely fucked. So don't trade USO, don't go for it. Even it can be tempting because you think oil is up, blah, blah, blah. But this is a bad reflection. And I think they closed the new assets, meaning that you can be trading now at a huge premium versus the last. So be extremely careful. Don't go for USO. Hi, Gregoire, do you think it's still worthwhile looking at fundamental trade ideas long short in this condition? Thanks. Yeah, I think you have to. It's always, look, when I started, as I said to many of you, is I was only looking at price action. So that was in 2000, and I was, when it was going up, I was buying. When it was selling, when it was going down, I was selling, and I was not thinking whatsoever. And then, I started to think. I joined this hedge fund, and I started to meet companies. I work on the DCF model. I was sitting to my ex-colleague, really nice guy. He helped me a lot. We went through a DCF model, and I learned a lot. So now I know that fundamentals, you have to do fundamentals. Otherwise, you're not going to be making money. And if you, in a market like this, I know it's hard because I see that my mentees could be struggling these days. But the reality is, you don't need to be generating 15 ideas per week, okay? And every week now, my mentees come and they have 1 to 2 ideas. And actually, out of these 1 to 2 ideas, there is always a trade almost. If you have 1 trade per week, that is good enough, okay? So I think, yes, fundamentals per trade are extremely important in any market. So long USD ZAR is the trade. Look, I might be completely wrong. And on those trades, I have to admit that, you can be easily wrong. But if I'm wrong, what's my downside? There is the peg, and we are close to 375. So if I'm wrong, it's not going to move. So I need to take care of the carry trade, obviously, and the cost of carry. But still, if you are local, and I think those pegs have been helping the region massively. So this is a really good thing. And I'm not calling for this peg to go, and I'm not hoping that the peg is going to go. I'm just saying that this is a massive risk. Why? Because for the first time in the last 30 years, oil is at 20 something for a long time, and it's putting huge pressure everywhere. So if you are local, you move everything in US dollar, and the deal and the trade is probably the peg could go away, and if it goes, then there is huge upside. Intel, so some debt, apparently it's not good. Yes, I agree. If you're listening to the earnings call, it can be frustrating because the reality is no one's got any visibility. Okay, so the companies will come, they will be talking, they will be reading their transcript, that they're going to say, yeah, take this question. They don't have any visibility, but you can smell that some are doing better than others. Okay, you can tell when the management is under control. It's like when you're trading and you put 10 traders in the trading room, and you know who is in control in terms of risk management. And that's the same with the company. And that means you don't need to be listening to all these earnings calls because you don't have the time to do it. You need to take the big guys. You need to take the ones where you want to have exposure. Next week, you want to be doing Amazon, the names that I mentioned as well. You want to know by industry what is the during earnings season, do you listen to every conference call or read every transcript? Okay, so if I bullshit you, I could tell you that I listen to every conference call and read every transcript. This is just not, it's not gonna happen. You don't have the time. So literally, when you're trading and you get the conference call that is coming out of your phone, which is extremely loud. So I remember sitting next to this French trader, and every conference call, you had this massive noise of the conference right in the open, and it was just really hard. But yes, you're going to be listening to some of them, and you're going to be reading some of the transcript. What I always say when I'm doing the mentoring program is you're better off sometimes listening to the conference call than reading the transcript. Why? Because you can hear when people are bullshitting you. So when a guy is bullshitting you and you can hear his voice, you can see that it's different. When you're reading the transcript, you're not even, sometimes you get it, but not always. But so I really like to read hearing the voice. And more importantly, if you have a position or if you want to put a position, you need to be listening to the earnings call live. Because in a market like this, they're going to be telling you things that can be very, very different than usual. So that's important to know what could be the changes even on a minute basis. Imagine that you have a position on Intel, okay, and Intel is coming with the numbers. They're going to be talking as well. If you have a position, you can be trading after market hours, but you don't want to come tomorrow and say, well, what did they say yesterday? Oh, the stock is down, because that's too late. Okay. I'm using the ISM and NMI to generate ideas. Is that fine in the long term? I'm waiting for VIX to come down to 20s or below so I can build long-short portfolio. If you have time, maybe you're going to wait another 18 months to be doing anything. Because if you look at the bear market and the tough market, you can have 12 to 18 months of high VIX above 20. That means you're not going to be doing anything. And this is why, the 4x4, I want to be generating ideas with special situation, active trading, and bottom up, because you're going to have many, many opportunities. So I think if you're stuck with the ISM and the NMI first, you can see these days, it's not a pure leading indicators, because actually it's lagging what has been happening. And secondly, the first thing when you look at the ISM and NMI is you take this universe of 18 sectors and you decide you go long and short those ones. And what about the other 15 that you have? So that means from the first minute you're doing your filtering, you are killing 80% of your universe. And out of this 80% of your universe, there might be very good opportunities. Is it possible to double your money every year? What return should people expect in a year? I hate those questions. I hate those questions because, because I hate those questions. I'm sorry, I don't hate you. I think, I know where it comes from. Yes, you can, but that means massive risk. If you want to be realistic, the best guys of this world, they are making 15, 20% every year compounded, and that's probably the best. So yes, you can double, but this year I came across someone contacted me and said, look, I was up 40% until mid-February because I was doing this with someone. Then I went down 50%. If you go up 40%, so you're at 140 NAV mid-February, and then you go down 50%, you're at 70. Okay, so that's a killer. So literally, what I'm trying to teach people is first you need to limit your downside. If you want to work in the industry, and if you show a P&L that is like blah, 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 and then you say, yeah, but this year I'm up 30%, they will never take you. If you take and you come with a book and the returns that are under control, then they will have a look at you, because they'll say, actually, these guys, even if, if you make 10% every year, which is quite a lot, okay, but with very little downside, trust me, people, you get a good chance. If you make 20%, then the next year you're done 20%. The year you're done 20%, you don't have a chance to find a job anymore. Okay. Can you please tell us your daily routine? I'll probably do a video about the daily routine. Treasury and gilts markets. Treasury and gilts market. I don't know what to think. I think they are trying to monetizing the whole world. It's just scary to think that the US 10 years is at 60 bips or below, and there is no hope inside that this year we're going to be running 10% plus deficit. I don't know. I think it's scary. The credit market is very scary. What do you think about the implied volatility? I'm expecting it to rise aggressively again with a proper returns to the bottom. Implied volatility 40%. I think there are many expectations. There are many people expecting that it's going to pick up again. Again, at the moment, we are trading sideways, 2650, 2850, meaning the volatility is coming down. Everything is kind of slowing. And then, I will be trading what I see. I'll be trading when it goes one way or another. But I think again, I've been talking to a credit trader, I've been talking to oil trader, commodity, I've been trading to equity traders. They have done pretty well. Some of them very, very well. Some of them just flattish. Is it the good time to go all in right now? No, I think it feels like people are just as one of my friends was telling me, is you don't want to be making any mistakes here. Okay, so why? Because there might be some moves, and you want to be ready to be able to be trading those moves. How do you keep stress free, especially in this market? There is no stress free. Look, I mean, one of the reasons I ended up, stopping trading end of 2017, 2018, and start of 2000, I was tired. Okay, I had 18 years of stress. And my wife looked at me and said, look, that is enough. We get too much stress. It is extremely stressful. So, and I think for the stress-free is you need to make sure that you like your mandate. And in a way, one of my colleagues was saying the following: you need to have a stop loss where you want to be sleeping well, and at the same time you don't want to be stopped out. So to get the stress free is you need to have a mandate that works for you. Okay, and this, we do have like different risk scenario, different risk appetite. So here, I don't have any answer. It is an extremely stressful job, okay? And people who are saying otherwise are just lying. This is stressful, this is extremely demanding, but the reward are so nice. When you make money, and I'm not saying, only the money, the feeling that you have when an idea is working, it's something that is a nice thing. But obviously there is a downside that if it doesn't work, then it's extremely painful as well. I'm not trading in this market currently, but what would you recommend I do during the day? A read transcript. What sources do you use for news flow? Do you use Reuters icon? Do you recommend it? So first thing first is, when you ask a question like this, is you're probably getting closer to the fear of missing out. So that means if the market keeps on moving without you, you're going to be jumping. So you want to make sure that your risk management is fine and you're not going to be doing any fuck up. In terms of resources, it's about building your infrastructure. So one of the struggles that we are all meeting is we get a lot of information, but we are struggling with our infrastructure and how to filter the data. Reuters icon is a good one. If you want to get a deal with them, it's a good platform. Instead of paying $2,000 with Bloomberg, it's $100. I like it. I like the API. I'm saying to my mentees, if you can't be data fishing, use Reuters icon. Yes, I like this platform. Optimal volatility levels for a long-short portfolio. There is no optimal volatility. It depends on market conditions. It depends on your mandate. If your mandate is to be making 5% every month, you're going to have a huge volatility mandate. There is no answer. It's like when people read the headlines and say, oh, this guy is up 50%. But if he's got a mandate to do it, that's fine. But you're not going to be able to have a 50% return when your mandate is to be making 5 to 10%. Do you recommend the Bloomberg terminal subscription? No, I don't. It's $2,000. It's too expensive. Unless I don't know even. No, I will not. I think you can do. You don't have it. Again, icon is good enough. If you have question on icon, let me know. Send me an email at contact@Gregoire Dupont, and I will answer. How many ideas should you come out per week or per month? I think you should be generating 1 to 3 ideas per week. Okay. If you look at a week like this one, which is a boring week, I came out with 2 ideas. One is a bit kind of long term because and hard to structure, which is the peg. The other one is an easy one. You can put the position, it's the risk management, and I put another one as well this week. So this week I generated 3 IDs and I put 2 trades. Am I going to be, before I used to be trading like massively, so every day. So again, you need to, what is important, and that's really hard. And I remember, I think it was in 2013, is I was looking at my screens, and there was my boss that came to me and said, patience is a virtue. And as a trader, when someone is telling you something like this, especially your boss, you're like, yeah, I want to be put in position. But he's right, okay? He was right, and you need to be patient. If I think what is key is each time you don't respect your process and you force the trade, you are first, there's a good chance you're going to be losing money. And the second thing that is for me, which has been the killer sometimes, is you really damaging your process, because you know that you might have a tendency to go for those fuck ups. How do you become mentee? Since I was referred to you by, how do you become mentees? You send me an email, we have a Skype call, and we see if we can do something. Again, mentoring program works very well. I think the mentoring program has been working very well as well for people that have been doing the 4x4 video series. I've been doing that since 2014. I've done that for another company. I think now I have my own product that I like really much. I think it works really well in different market conditions. This is my product, something that I like. I understand that people have done some other education, but I like what I've done. The feedback that I have so far is extremely strong. So inshallah, it's gonna carry on. What else? How should we balance our fund distribution into short-term 1 to 3 months trading versus long-term value investing? Okay, so I don't think you should be putting necessarily the long-term as a concept of value, because value means, it's very often the low P, low book. I think you need to have different time frames in your portfolio. In a market like this, you can have 1 week, you can have 1 to 3 months, you can have 6 months, you can have 12 months. You need to have a bit of everything, because you don't want to be in a situation where actually you put all your ideas in the same bracket of time frame, paying the same kind of betting on the same kind of implied volatility. Nothing is happening, and you lose your money everywhere. Not only with options, because implied volatility is dying, meaning the premium is getting lost. But I think you need to start to try to have different time frame. I know it's really hard, and it's easy to say for me as a mentor to tell people you need to have different time frames. Me, I've done a bit of everything. I started very short term. I've done hedge fund where you do 1 minute to 5 years. When you do active trading for a prop shop, you do between literally 1 minute and 1 to 2 months. That means the time frame is different. Now my conviction is literally for you, and this is why I'm happy to have my mandate here, because I can be trading my money with my own mandate. When you're working for a hedge fund, you have a mandate. When you work for prop trading, you have a mandate. So something is imposed by someone. Hi, Gregoire. The math is often wrong, and everyone expects the goal to break out. Which downside with equities moving lower, for instance, would you target? Again, on the gold, as I've been telling you many times, I'm not a specialist, okay? So I'm not going to bullshit people. And I don't like the doom and gloom retail kind of things. But I look at the price action because I'm a trader, and I look at this 1800 as the big level. If it goes 1800, then I don't care, I'll go with it, okay? At the moment, I know that any retail trader that is starting with above 30 is probably going for the gold, with below under 30 is probably going for Bitcoin. and in between, so you get this natural flow. But then, you know, again, I'm looking at the price action. I'm not going to make comment about Steve Cohen. What else? How do you trade earnings season? There is no. Good question about at what level of volatility would you start trading options more than buying the stock? That's a good question, because I know this person and I know what he's trying to tell me. So I think if you look at implied volatility, okay, implied volatility through the VIX, which was created in 1991, implied volatility has been averaging 19% roughly, okay? So that's your average over time. If you look at the last 5 years also, we were at 16% or below, very low volatility. 2017 was a killer. 2016 was very, very low. So when volatility is above, implied volatility is above 30, 40%, I know that the premium is high. That doesn't mean it could not go higher, but that means that when I'm entering the trade, the implied volatility could be costly. So I know that I will have to structure the trade in a way that is not too expensive for me, so maybe put spread. But you know, 30% below, I know. So if we look at this move that we had recently, so the first move, when it was implied volatility at 15, that was a no-brainer. You do all your hedging through options. When it goes to 30%, you know, if you've been in, you can be taking profit, or you can carry on if you're really good, which I'm not, and you go all the way to the high level. Now we are at 40%. The realized volatility seems to be much lower now, okay? So volatility is coming down. Now, what about you wait a bit before playing the volatility at this level? Companies are all pulling their guidance. So for the future, how do I generate long-short ideas when they pull their guidance? I think that is a good question here. Is by definition, when you look at any business model, okay, any business model, when you look at a DCF model and an analyst is telling you in 2021 they're going to have X numbers, you know it's complete bullshit. If you talk to, and if you listen to most of the transcripts, and if you've been through more than one economic cycle, you know that in reality, most businesses have 3 to 6 months visibility. After that, they have almost nothing. And even the defensive stories, if you look at Boeing, if you look at Airbus, if you look at those companies that are telling you I have 20 years of backlog, look at Boeing. Their 20 years backlog is going to go away because all the airlines are going to tell them for the next 2 years we're not going to be buying something. So what you need to try to be figured out is, you know, what is the positioning of this company in the sector, in the sector, then the industry, if they have something that is better than the others. Okay, what is the quality of the management? What are the expectations? I think these days, one of the questions, and I think one of the good trade is actually, there are two things. The so-called defensive companies that are not defensive, okay, that actually you could be shorting because you know that actually their backlog is a farce. And I think this is the first one. And then you have the kind of cyclical company, non-cyclical companies, but actually that are cyclical, or defensive companies that are in reality cyclical. And when I say that, you have many defensive companies that are going to tell you, I got 3 months backlog. Okay, I'm selling this. Don't worry. So they will come with their earnings here. They say, we don't have much visibility, but actually we get 3 months backlog. And then in 3 months' time, they're going to tell you, but actually we sold off all our backlog and now we don't have any new business. So you need to be looking not only at the backlog, but the new orders. And as we have Intel tonight, I remember Intel in 2008. So they came with their earnings, I think it was in summer, And they say, and I think it was the sales, and their sales at that time was roughly 11 billion per quarter. And literally 10 days later, they say, look, guys, we're not going to be doing 11 billion as we were expecting 10 days ago. We're going to be making 8 billion. So after 10 days, they cut their numbers by 30%. So here, even if a company is going to tell you it's all good or it's all bad, you need to be extremely, extremely careful. Okay. Correlation between two securities. If you want to have correlation between two securities, it's the 4x4 video series. It's well explained. Could you expand a little on your comments about ETFs and how they can be deceiving, mainly the mandate part? What will be the pitfalls to watch out for? So thank you for that question. I think ETF, ETF, we know this is passive investment. So passive investment in the US over the last 10 years have been growing massively. Okay, so you have now ETF for 80 industries, 11 sectors across countries, blah, 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 blah. But you do have so the first thing that I look for is the counterparties. So who's making the ETF? If that's a small player, I know that if there is risk, if there is move, actually this counterparty could go under. Okay, so that's my first risk. The second risk, as I said, is the mandate. So you need, most of the time, if you look at the industries, if you look at the sectors, normally it's plain vanilla. It's pretty easy to understand. So they hold the same weighting as the industry or the sector or the index. But sometimes they don't. USO is a good example. And there are some other names that you need to look at the ponderation, the weighting of all those ETFs. So going to the mandate, you can go on websites like ETF.com, which are helpful, explaining, what is the ponderation, what they're made of, what's the cost attached to that. What else? Do you cover how to trade during periods with high VIX in 4x4? Again, the whole idea of the 4x4 is trying to help people if what I've been doing for the last 20 years. Okay, it's not gonna be let's say the magic formula. Okay, I'm not pretending like this is the magic formula, but if in a market like this, there are massive opportunities as well. Okay, and I'm not saying that just to make people believe that there are easy money to be making, but when the VIX is high, implied volatility is high, there is trading opportunities. You need to be looking at different things. So when in the 4x4 video series, we spend a lot of time on price action, when we spend a lot of time understanding where to be putting the money, that works, okay? And that works really well. But that you need to learn because it is a learning process. Last week you covered a bit the banks. The numbers of provision for bad loans have been interesting. Do you have an opinion on lenders like Capital One? I don't have a real view on Capital One on some single name. I will have to do more work. I know that the sector is really struggling. I mean, you don't need to be a genius to say that. And the price action is telling you the same. I think, coming back to your question, you need to look at what they are exposed to. I mean, is it mortgage? Is it corporate? Is it, where is it in the US? Which sectors? Last week, one of my mentees was struggling. So we look at banks and I say, okay, if you think about banks, you could be generating 2 IDs on regional banks. You can be generating, so coming back on oil, okay? So which part of the world or which part of the US is struggling? Texas is probably struggling like there is no tomorrow because of their oil exposure. So if you find the local region, the regional bank that is in Texas that is listed, and I'm not going to give you the name, maybe that gives you a good shot. Then if you go on the other part of the US, which is California. So California is exposed to what? Is exposed to private equity, is exposed to technology, and is exposed to real estate. If you think that these bubbles are going to explode, you want to find the regional banks that have exposure to California. Okay. How many IDs should I have in my watch list if I start with $450,000, and how many should I have in my portfolio? So the question is not the size of your book, okay? Because you could have, say, $450,000, you could have, say, 450 million. The thing is, you need to do the risk management first and understand how to do the risk management. And when I say risk management, is concentration of each position and diversification. So again, 4x4 video series, there are 4 or 5 videos. I think this is something that is really missing across the industry of education. If you do 450, it depends where you are, okay, physically, if you are in the US, if you are in Europe, if you are in the Middle East, what kind of leverage you can have. Based on that, on top of that, we're going to be deciding, you know, what's your exposure by position. My philosophy is I don't want to have more than 10% on a single position, okay? But then we have the net exposure, the gross exposure, blah, blah, blah. So I'm happy to help you. I'm happy to do the mentoring program with you. If you want to come with your $450,000, we can work on this. I'm happy to help you. What time frame did you do when you were a pro? So when I was a pro, I did literally from 1 minute to 2 to 5 years. So I did everything. When I started, that was active trading. Okay, so from 1 minute to 1 to 2 months. When I was doing a hedge fund, I was hired to do a lot of active trading because that was my background, and that was to be managing the book as well. And that means I was lucky to be working with smart people, and those smart people, I learned how to be looking at different time frames, longer time frames. So when the team was buying, you know, a rig project, when the rig project was about, you know, putting $5 to $10 million, and from the moment you put the 5 to 10 millions first, the product is barely listed. You need to build the rig in Asia or in Europe. That's going to take 12 to 18 months. You need to be meeting the management. So we are talking project 3 to 5 years. So that will be my time frame. What else? What else? Have you got any advice for someone applying to a hedge fund this year with a profitable track record? I think you need to be lucky, because the hedge funds that there are names that are suffering. When you go and you apply for a hedge fund, in the meantime, there are 2 things. You need to come with a good track record, but numbers that are not going all the way. And even if you want to be aggressive, you don't want to be too aggressive. Why? Because you're joining a team. And if you come and say, look, guys, I'm the best, they will look at you and say, we're not interested in someone that is that aggressive. I think that is for 80% of the people. So I think there is a misconception of, you know, we are the king of the world and we're going to destroy everyone. I think this is extremely misleading. Hedge funds are looking for assets that they don't have necessarily. They are looking for people that can bring something different. They are looking for people that have a strong risk management, a strong idea generation, and in the meantime, know that the learning curve is endless. If you come and say, I know everything, you have absolutely no chance. So the answer that I'm giving you is not a good one. I'm afraid, but if you have these returns for 12, 18 months with decent money, I think people could be looking at your track record. If you have a good track record, you can contact me, and then I can help you somewhere. But I will have to look at your numbers first. And what else? What time is it? Okay, let's spend another 5 minutes then. What's the difference between your previous employer and yours? I mean, if you've been watching the videos, if you've been watching me, if you've been going through the product, there are so many. There are so many. It's just that I'm very happy to have my own product. That product that is the way I want it to be, the way I wanted to talk with people, the way I want people to understand what is the industry, and not the industry of 15 or 20 years ago. And how people and helping people grow. And if we think about the product was done. The video series was done 5 months ago, so it's extremely new. It is here to help you from the beginning to the end. Okay, so my concept is, if you come to me and you want to learn, I need to help you and I need to give you the tools. If I tell you, you could need to find your own way, that doesn't work like this. So hopefully the people that have access to my product are happy. But there are so many differences. And again, the feedback that I have is just ridiculous. Really, really good feedback. People are very happy, and people that have done both products. My local gold shop can't deliver gold at the moment, no more stocks. Yeah. So that is extremely true. So when gold was trading at 1600, there were many talks that there was no delivery. Okay, and actually let's say the physical was trading at 1800 or above when the future was trading at 1600. And if you remember, in one of the videos, I discussed about the CME that changed part of the future contract to have more physical when you do the delivery. And if you remember, there was a squeeze on the future recently, because people had to be buying the future because they wanted to have access to the physical. So I know there is a massive, not massive, but there is a gap between the cash and the future, and this is why as well the futures get so much strong buying pressure. If you want to have risk management, again, do the 4x4 video series. Again, this is so strong. I think the videos, ask people that are on the chat here, and there are some people that bought it. It is extremely strong. My opinion on Bitcoin. So Bitcoin, I never traded Bitcoin. Okay, why I never traded Bitcoin is because I hate trading something where there is massive counterparty risk. Okay, so when people is telling me, oh, you can go on that exchange, or you could go on that exchange, or you could go to that exchange, but there is a risk that you need to have the password. First, I'm probably too old, but I'm fine with it, because at the end of the day, if the market is still not completely fine for us to be trading in 2020, that means there is massive counterparty risk, and I just don't like it. So on the fundamental, I don't know about the fundamental, but really, and when I tweet on it, and when I make, at the end of the day, I understand that people want to park their money somewhere, and they think that Bitcoin is the way to go. But if Bitcoin is pegged, or is against the dollar, you have to explain to me something first. But again, am I going to go against the Bitcoin? No. But I hate when there is counterparty risk. If you can find me, because many people will come to me and say, look, Greg, that's not true. I can tell you there's this market here. You can go on that exchange. And one of my friends here in London is trading Bitcoin, and I've been trading arbitrage between different exchanges. And he said to me, I've been making good money because there has been massive arbitrage opportunities between markets. Why? Because there is counterparty. So no one trusts anyone. And that gives me opportunity. Am I going to be putting my money into something where I believe that if we wake up in the morning, if I put $100,000, it could be gone tomorrow morning? No. So do I keep a journal? I do. So for when I was actively trading for 18 years, we had a system. Okay, so you had a system where you were trading and they were putting your trades automatically. And every day after the close, I was using an Excel spreadsheet and putting all my trades. Because why? At the end of each day, I want to be able to, when the market is slowing, when it's closed actually, I want to know what I've done. So I put my trades and I'll say, okay, I bought X stocks at this price. And that tells me first, what's my size, what was my timing. And then I reflect on the day of why I've been doing those trades. Okay, so that gives me my strategies. And sometimes I'll be like, okay, I took profit here. Okay, that's fine. Or sometimes I'll be like, I kept on taking profit quickly. Why is the fuck up these days with me? And keeping a journal, for me, is extremely powerful because that tells you in the good times and the bad times when and how you're making money. And that tells you a lot about the market. So what do you think about this broker? So someone asked me the same question about this broker. Look, do your own research. I spent 5 minutes doing this research. It sounds like I don't know if I. So on putting your money with a broker, do your own research. Okay, what's the counterparty risk? What's the upside of going for a broker where you never heard the name and you're going to be parking 20, 50, 100, whatever? I still don't get it. If you do it, you put all your money at risk. There are some good brokers, interactive brokers, they get hit. Interactive broker get hit yesterday by the 100 millions on the oil market. Are they closed? No, they are still running. If you take a dodgy broker who could be in the UK, which could be in Malta, whatever, that can be extremely risky. Plus, you don't know the deal that you have between this broker and the person that is calling for you to be using it. What else should I do? If you want to know what's the price of the mentoring, you come to me and we talk. How can you trade on the 1 minute time frame? You can. It's a different setup. I can tell you the setup is the following: is you get alerts, filters on 50 words, and those words are going to be on M&A. And there is one of my mentees, I asked him in 2015, 2016 to build for me a Twitter alert. So we were filtering all Twitters, all internet website based on different names. So I knew that there were 10 websites that were coming with first information on M&A. So I had the alert before most people and actually most algos, and I was able to be buying or selling those things. And literally you are making 5-10% in 1 minute. But here again, you need the setup. You don't need to be necessarily professional, but you need to have the setup. Is there an age ceiling where hedge funds don't recruit above? No, I don't think. I think, hedge funds could be very open. Plus, I think there is the myth of the hedge funds. Hedge funds could be family, could be a different platform. As long as you could bring something, there is no edge ceiling. I think the thing is it is extremely competitive environment, extremely competitive industry. So when I started in 2000, right after business school, I knew that it was competitive, and the only edge that you have is not saying I'm more motivated than the others. I'm gonna do more hours, blah blah blah. Is you need something. So I came and said, look, I've been trading for the last 6 or 12 months, and actually I was pretty open. I was struggling. I think I already had one. I had a stop loss already, a big one, and I was fine. But you need to have something different. You need, if you want to work in the industry, you need to tell people that you get, as the other one would be saying, skin in the game. Otherwise, it's just like you want to be, but there are tens of thousands of people who want to be. What does mentoring add that 4x4 does not have? Okay, so if you do, when you do the mentoring, you are putting live your own money, and I help you doing that. Okay, that's a very different concept than only doing the 4x4. So the 4x4, you understand the process. When we do the mentoring, we do that live for 12 sessions over 3 to 5 months. Okay. And we're going to be going through all the sectors. So if you think about the S&P 500, there are 11 sectors. Okay, so I do 12 sessions because I want you and I want us to be covering all the sectors. Those 11 sectors are not going to be the same fundamentals. They're not going to have the same drivers. That, that comes from experience, things that I've been doing over years. Make sure there are people that are better than me at trading the market or portfolio management. But the reality is, if you have someone helping you, that makes massive difference. Plus, it is about building your infrastructure. That takes time. You need someone to help you doing it. I remember, and that's one of the biggest difference from when I started doing the mentoring program. When I started doing the mentoring program for my previous company, I used to do everything with my Bloomberg. So people were joining the show, and that was literally a show. So I was opening my Bloomberg, and then they were reading the Bloomberg. Was like, wow, Greg is a pro. He's got the Bloomberg, and and they could see me trading, blah blah blah. But then when I decided to launch my own video series and my own mentoring program, I thought, if people come to me, literally they want a process. Okay, they don't want a process based on something that doesn't work. And I said to myself, okay, I need to help them having the process from the beginning to the end. So building the infrastructure, which website to go for, how to build your spreadsheets, which website to be using, where to get the information. And that, it took me 18 months to think about the 4x4 video series. So it took me so I had 5 years of mentoring experience, mentoring people on a product that was not mine. And I said, no, this is not me. This is not the product that I like. There are so many things that I don't like. I want something different. And at the same time, I knew that one of the key to be successful is for you to have your own infrastructure. And here, I wanted to be very strong. And I think hopefully if you contact people that have been doing it, this is something that I managed to do. Okay. I wonder when you two into the field in the first place, childhood and growing up. Hi, Gregoire. Firstly, thank you for such a wonderful presentation. I take that one. I wonder what interested you into the field in the first place in childhood and growing up. So I think I started to be interested in markets when I always liked naturally understanding macroeconomy. I really liked it. And then I remember my sister, she was at uni, and she was at the best uni for finance in France. And so literally I heard people, talking the future traders, and brokers and blah, blah. And I started to get interested, and I went into business school, and that was extremely natural because it's such a challenging world. It's such a nice world to, and look, it was hard, at the end of 2017, I had enough of it. So I went through very good days and tough days. And when you're trading, because I know you and I follow you on Twitter. And I know that sometimes we get some good days and sometimes we really get some bad days. And I think what I learned from my trading over the years, and especially after the recent attacks that I had through the mentoring from him, I know that when you're a trader, you bounce back. Okay, so you fight, you go, you carry on, and for that, that is the beauty of the portfolio management, and going for the fight every day, and that is why I feel, even if a couple of years ago I really wanted to take a big break, it took me back naturally, because I think it's a big part of me being a trader like this now. What else do we have? Can we do a webinar on your journal, please? Yes, we should. Can I use IB as my track record? Yes, you can be using IB. And here, let me give you an example. When I was working for my prop trading company, I was sometimes part of the hiring process. Okay, so people were coming to us and say, "Look, we got this track record. If you are coming with a track record based on Excel spreadsheet, no way, not interested. If you are coming with IB, which is clean, then we will be looking at it." Why? Because if you are a professional, many professionals are now trading on IB. Okay. Because they have enough of the mandate, because they don't have any mandate anymore. So IB is really legit. It is a good one. If you got a good track record and you're happy to show it to me, then I'm happy to show it to some people. What about the next question? How much does it cost to set up a hedge fund? It's so expensive. It's just ridiculous, because you get regulation, you get everything. So literally the ticket for the cost is probably, let's say, $500,000. So to have a hedge fund, you need to think that to be break even, you want to make sure that you're going to be raising 20 to 50 million USD. Otherwise, it's pointless. Have you ever given up on mentees? What does a mentee need to be a successful mentee? I never gave up, I think. Sometimes, out of the, let's say, maybe 100 that I've been doing now, there have been 5% of them, let's say 5, where I really, really struggled. And there was a mismatch in terms of the person and I. But to be honest, I really enjoy the mentoring. I find it extremely challenging. I like seeing people growing. So I don't give up. It's when I'll feel like I'm going to give up, then that will be the time for me to do something different. Okay. When I felt like when I was trading that I was not up 100%, I say, okay, this is time for me to take a step back. Since January, I decided to come back to active trade. To come back to trading, okay, because I want to do it. And here at the moment, when people come to me, I said, I really enjoy doing the mentoring program. I really enjoy mentoring people. This is my reality now. Maybe in 6 months or 12 months, it's going to be different. But at the moment, I enjoy doing it. I enjoyed so much doing the 4x4 video series. I enjoyed it because I thought the product was really good. And that was all my years of trading, portfolio management, and as a mentor. If I do get Bloomberg because I can afford it, will this help as I will get the information quicker? No, you'll get if you get Bloomberg, you get everything on the same platform, which is helpful. And you get a strong Excel API, which is nice. If you are good at coding, that will be even better, and you can do many things. For the first time, Greg, you blushed on camera. I'm very shy in reality. Any books or blogs you recommend I read? Books, there are many, and at the same time, there are not that many. I'm a believer that you should be doing things before reading. I mean, there are too many books. There are so many bullshit. I mean, my downside is I started working in 20 years ago. So 20 years ago, there was not that many blogs and books and everything. So you were learning by doing. Okay, so now when I see all these concepts that are, especially for me as a French speaker, and I see that in English, I'm like, there are wording for some strategies, for some things on volume, on price action and some things. And actually those are things that I've been doing naturally for the last 15, 20 years, and I've never put words into that. So me, I do things. There are some very good blogs. There are some very good people on Twitter, really, really good guys that you should be following. The thing is, you learn when you've been in the market and you know where to see the difference between the bullshit and the real good people. Do you think it's hard to be a successful trader going forward compared to when you grew up, especially deploying long-short portfolio? I think it's always hard. It's always hard, and because you can argue that these days could be extremely easy for the last 2 months, because there is a lot of volatility, and some others will tell you no, high volatility is not nice. So there is always a reason. The hardest part of being a trader, the hardest part and the most enjoyable part is it's extremely challenging. So that means one day is always different from another. And at the same time, there will be days that will be exactly the same as before. But when you come in the morning, you don't know it's going to be the same as before. And that's the beauty of it. And is, yes, the market is harder because if you think in terms of returns, the returns have come down massively. Okay, so if you were long bonds, that's a bad idea, a bad example because bonds have been going higher and higher. But normally, if you look at yields on bonds, they were 6-10%, whereas now they are at 0, negative. So you should argue that if the biggest market of all is got low yields, low returns, that's harder. My conviction, and that has always been the same, is for the stock market. There are always opportunities every single day of every day. If I had the motivation again and I had the right mandate, because for me this is the mandate, and the right management, I will be happy to go back. But the thing at the moment is I enjoy more, doing my trading, which is not as active, and teaching people. But yes, there are always opportunities. That's the beauty of it, and this is why you're listening to this call, because you think the same as me. Should I carry on? How do we know our track record is good? That you need to test and see. What else do we have? Zax, anything? Have you heard of anyone using the Zax Excel add-in? No. Would you read FT or Wall Street Journal? Will I get the paper? No, but there are some good articles. It's like any platforms. There are some good and some bad. FT, if you're talking about FT, you could be reading FT Alphaville. Okay, so FT Alphaville is for free. They are good journalists, very good people. They are very professional. They cover well the UK market, which is not my main market. But yes, I think, FT is a good newspaper. There are some good things. Okay, I think, do you subscribe to The Economist? No, but I read it from time to time, but I don't subscribe. If you were in your 20s, what would you do right now to become a successful trader, I guess? I will call me. I will be watching the 4x4 video series, and I will be doing the mentoring with me. And then I will start, more or less. Yes, I still build portfolio. Yes, I still do. I still enjoy. I mean, as I said, I enjoy it again, which I was not enjoying, which I decided it was time to take a breather for a couple of years. But I enjoy it very much. Okay, everyone, all good. So 2 hours, not bad. Thank you for joining, all of you. If you have questions on the market, if you have questions about the 4x4 video series, which work well, if you have questions on the mentoring, which work well, you can contact me. I really enjoy it. The ideas that are covered today, again, it's about the process. I'm not telling you you should be putting those ideas. So be extremely careful between what educators are telling you and what you should be doing. We all have different time frames, different risk management, risk profile, and so on. But again, I enjoy doing it. I hope it helps some of you, and talk to you very soon. Thank you, all of you, and bye-bye.